When you look at some of
Morning.
the strength that has been moving specifically towards tech, I've kind of been joking that it turns out the whole NASDAQ is a stay-at-home trade. So is that really the case, or have markets lost their marbles here with the big move up off the lows?
Yeah, it's been quite interesting. And in the fact that looking at that momentum part of the market, right, the NASDAQ being predominantly in that space, and just tracking it relative to what happened in the last volatility bout we saw in the fourth quarter of 2018, we're seeing kind of a drastic change what we're seeing in the current environment. It definitely seems like a stay-at-home trade. You have the Megacaps growth kind of leading the market in what appears to be a very unconventional risk environment, right? Typically, you'd expect maybe some dividend factors to outperform or maybe some value to slightly outperform here and there. And we're simply not seeing that. Those growthy NASDAQ names continue to dominate the market environment.
Is this, in your mind, because it makes sense for them to do that at a time when we're overloading all of the data centers and online providers, or is this just a classic case of easy money response and investors buying up risky growth because the Fed's got our back?
I think it's a combination of everything. I think predominantly, in our view, the fact that we're dealing in an environment where nobody has had any experience whatsoever in manually pulling the economic activity emergency brake, so to speak. I think people and investors are kind of pushing themselves to those riskier names that they're more comfortable with, that they know their backdrop, they know their business model slightly better. I think one thing we're seeing dominantly, even in today's data points and data points leading up to today, is that economist estimates and overall analyst estimates are kind of all over the place because we simply don't know how to gauge exactly what's happening. I think that kind of lack of perspective, not only does it produce these massive dislocations we're seeing, but tends to actually bias us to some of those growthier names that we're more comfortable with.
Right now, you've got a market trying to process really bad retail sales this morning, trying to process really bad Empire State Manufacturing. When these terrible numbers started hitting the tape, when we were at 2,500 or 2,400 in the S&P, it seemed like maybe there's a little bit more potential to manage it. Is this now a rally that needs to have some confirmation that things can turn the corner? Are we going to be able to process this abysmal data back almost to S&P 2,900? I mean, I imagine that's a pretty big difference than handling it 700 points lower.
I think volatility is definitely in our future. Okay. I don't think volatility is necessarily going to retest the bottoms that we experience, but I think when we get data points like this, when we start to reassess that the short term may actually be slightly worse than we may have anticipated. But if you kind of take a step back and truly kind of gauge what the estimates are for 3, 6, 9 months out, kind of how that economic outlook may kind of transpire once these quarantine efforts are lifted, I think the current environment has started to price that in a little bit. But I do think volatility in the short term is back into our future. I think I wouldn't be surprised if the S&P 500 shaves off another 10 to 12% from here to the downside before kind of establishing a better bottoming process. I think the data points, again, are going to continue to be worse than anticipated in the short term. It's very difficult for us to gauge how bad this economic situation has been. And in that time frame, I do think the same factors that have been gaining value and gaining positive momentum are likely to continue to do so just here probably over the next 3 months or so.
As the Megacaps lead again, Amazon's back to highs. The Russell 2000 has been lagging. Regional banks have been really struggling. Yesterday was another bad day after some of the banks started reporting earnings. Is this group just left for dead if the domestic picture is going to be ailing for some time? Is the Russell 2000 improperly priced so far behind its peers, or is this just a place to avoid?
I don't think it's a place to avoid. I think it's certainly a place you consider underweighting. I think the biggest dislocation right now in the market appears to be in the mid-cap stocks. You have low single-digit valuations from a PE standpoint in a lot of those individual names, and you have notably stronger balance sheets relative to the Russell 2000. I think as we get out of this dislocation, small caps could certainly produce positive long-term, strong long-term returns. I think mid-caps have a much better chance in this environment for a potential upside. That's what we're looking at some things right now. But I do think the mega caps still play a dominant role, maybe slightly underweighting them as we start to get out kind of this economic mess we're in.
Okay, so right now, just to make sure I heard you right, mid caps being a potential value here as getting what kind of looped in with the small cap domestic trade when maybe they do have some of the same qualities as the bigger companies, international exposure, trends in technology. Walk me through why you think that group should be performing better.
Yeah. So first of all, domestic diversification in general has failed investors over the past three and a half years or so. The small caps, mid caps on a blend basis have underperformed the cap weighted S&P 500, as has the equal weighted S&P 500, right? It's been a very growth oriented environment. I think when we look at fundamentals right now and we look at, some of these mid cap stocks that have these stronger balance sheets, X energy, by the way, looking outside of the energy sector, so we don't bias ourselves in kind of what's happening in that environment. We have names on a relative basis that have just gotten tremendously beat up to the downside when the justification for such a downside isn't really there when you look at the underlying fundamentals. I think as we get out of this and as the economy reopens and as those names start to actually get recapitalized even better, I think we do tend to see a better potential in that space for relative positive performance to the current S&P 500 leaders.
Ed, one other thing here, when you look at just the long-term picture, I mean, we can dice it up by winners, losers, outperformers, and all this, but for those with a long-term horizon, does history just favor them buying up at this far off the highs, or is that an easier call, 30% as opposed to 20%? What does history tell us?
History tells us is to buy now, right? And the reason I say that is when we look at event-driven bear markets such as this, and the reason this is event-driven is because if you look at where we were at on February 28th of 2020, the economy did not have any pre-existing health conditions, so to speak, severe enough to cause a structural type recession. So we entered into a bear market from an event-driven, manually kind of done economic downturn in an effort to preserve human life. And that is the right thing to do, absolutely.